Welcome back to another episode of What the FICC. I'm Spencer Israel, joined as always by Ian Culley. He is head of FICC at All Star Charts. Ian, this question just occurred to me 30 seconds ago. FICC, FICC, it's fixed income. Is it currencies, commodities, or commodities, currencies, or does it not matter?
I say commodities and then currencies only because bonds and commodities are, well, they're asset classes, and currencies aren't considered a real asset class. But I think you'd say it however you want. I don't think it matters.
I will going forward. Today we are talking mostly about currencies. That's going to be the theme of today's show. But before we get to that, let's start off with a market recap here, and you can go ahead and bring your charts up on the screen, and let's let you run through all the commodities and the treasuries and all that stuff. So let's go. Market recap. What do we got?
We usually like to start off with precious metals. The first chart I brought today, silver futures. I had my eye on that 24.75 level, a key polarity zone. Bulls needed to step in and defend that level. They did not last week. Silver broke down and opened up path of least resistance lower. Risks are now to the downside for silver, and with risk to the downside for gold's crazy cousin, that spills over into the gold market. Gold pulling back towards this shelf of former lows from last month. Last month's pivot lows around 1980. That's the level that's been on my eye. It broke through that level briefly earlier today. It's back above, trading around 1983. You can see here, coincides with the pivot high also from earlier in the year. Gold below 1975 is 1980. And risks are to the downside. We're seeing a much deeper correction, maybe all the way back to the 1800. Gold ETF, it was holding its breakout last week, past couple of weeks above 185, and now it's losing that breakout. Gold is now, precious metals in general are now in a corrective phase. They're below overhead supply. Now the question is, are we going to get a consolidation or correction through time? Are bulls going to come in and support prices, or are we going to get a correction through price? Are we going to see a deeper correction with prices sliding lower? We got GDX. Again, GDX low for GDX around 33 and a quarter. Coincided with a gap lower last spring and a shelf of former highs here. Turned in support last month. Now GDX below 33 and a quarter. Risks are now to the downside for metal and mining stocks. Switching gears over to crude. Crude's hanging tough. Crude's hanging tough. And that's come over some selling pressure in the past few sessions. We'll get to that in a second, but it's holding above 2019, 2020, early 2021 highs. Now that level of resistance turned into support late 2021. And in 2022 and earlier this year, that 65 level continuing to act as support. Will it hold? That's a big question. Crude oil futures, potential failed breakdown. We call it a failed breakdown. Strong move higher after it sliced that 65 level early in the month, but it can't get above that 74 handle. Crude oil futures have yet to attain that 74 handle, and selling pressure is picking up. So that's, as long as it's below that 74, I think 65 is in the cards. USO, oil ETF at 58 level. That's what we're watching. Watching those pivot highs from October of last year, the April low of this year. If USO is back below 58, risks are to the downside. Now, copper, Dr. Copper. Base and industrial metals are starting to experience similar selling pressure that the energy space has been dealing with for months. Copper broke below a key level, failed to hold above that $4 handle, now down near 350. Zooming in, we were watching that 378, the September highs from last year. Copper broke down and is continuing to catch lower. This is not a good sign for global risk assets and cyclical stocks just in general. and commodities to see Dr. Copper rolling over. It also kind of speaks to a potential breakdown in yields. We've yet to see it though. FCX holding above our level of interest around 33. It's getting close, but it's still hanging in there. If and when FCX takes out that 33 level, watch out below. Risks are to the downside. Bears are in control and potentially revisiting those lows from last summer. Again, why do we care about copper? Just moves tick for tick over longer time frames with global risk assets. Lower part of the chart here, we have the global Dow. This is 100 charts, 100, stocks, blue chip international stocks, some of the best stocks in the world. And they just, if Dr. Copper isn't doing well, copper futures are rolling over, they most likely will follow. So keeping an eye on the GDow and further weakness in copper. And that brings us to rates. Well, they're not rolling over. Not rolling over. We don't have red circles here for the 5, 10, and the 30-year hasn't even broken below these this shelf of former lows here from earlier in the year and late last year. The 10, 5-year kind of teasing a breakdown or rolling over, declining, just not happening, not materializing, right? TLT, long duration treasury bond ETF, carving out a nice base, but stuck below overhead supply here around 110. If and when we get back above that level, like along towards 120, still in a bullish regime, but just no real movement here. Sideways is the trend for treasuries right now. 30-year T-bond, same story. Sideways is the trend. Sellers continue to come in around 132.18. Let's call 133. They keep selling, right? These bulls need to absorb all of the selling pressure, all of this supply, and take out this level, driving prices higher. If and when they do, upside target around 143. Short duration, a 2-year. Still, we're seeing a lot of these bases that look constructive. There just hasn't been any resolution. And that speaks to rates continuing to chop sideways. Now on to the dollar. I think the dollar and the 10-year yield, they follow the same path. Now, the 126-day rolling correlation we see on the bottom pane here of this chart speaks to that positive, that strong positive relationship between these two charts over the past year and a half. I don't see that changing anytime soon. So if the 10-year yield's going to break down, it's most likely, rolling over an environment where the dollar's weakening. Now, what's interesting is last week, the US dollar index, DXY, had one of its best weeks, since peaking last September.
Wow.
That's not the type of, that's not something you see in a bear market, right? That's not the type of action that tends to precede a breakdown.
You're giving me conflicting signals here, Ian, because you're telling me on the one hand that the dollar just had its best week in what, 6 months or more, and that's a bullish indicator. But then the other side, you have the risk assets in commodities, gold, silver, copper, breaking down. I don't know who to believe. Who do I believe?
Well, that makes sense. Believe in both.
Okay.
The market's never wrong. I might not necessarily, in the moment fully grasp exactly what the market's communicating to me, but the market is never wrong. Now, if this dollar continues to catch higher, then those risk assets that you just mentioned are most likely rolling over. So to see those breakdowns in silver, to see the selling pressure hit gold, copper breaking down, energy continuing to struggle, that makes sense as the dollar begins to catch higher.
Okay.
Yeah, so that actually makes sense.
Okay.
Now the question is, when you zoom out, Are we just getting, a classic retest of these former highs, 2016, 2020? Or we're just pausing before an eventual downside resolution? Now, what's interesting is if we look at the 14-day RSI here in the lower pane, despite this strong sell-off, I mean, the dollar dropped 10%. The dollar index dropped 10% off its September highs within a few months, yet never hit an oversold reading on the 14-day RSI, reading below 30. It's really interesting. So I want, in order to have a strong conviction that the dollar is going to continue lower, I want to see an oversold print below 30. That would signal that the bears are in control of this market. Right now, it's a range-bound mess. I'm turning sideways for almost 5 months now, a little longer. As long as it's above 101, again, it's range-bound. Not necessarily a terrible scenario for risk assets and stocks.
Sure. So just not convicted on one way or the other.
Just right. Near term, it's sideways. Near term, it's sideways. We get back below 101. I want to see an oversold reading. For now, this makes sense. Now, if the dollar index gets back above 105, and we'll look at some charts later that will kind of give us an indication or a heads up that might be in the cards.
Yep.
If dollar index is back above 105, then risk assets are coming under increased pressure. The charts you mentioned earlier, gold, copper, crude, probably all continuing to catch lower, making fresh lows. So keeping an eye on the dollar, and that's why the dollar is so important. And what's interesting is that when we look at the broader scope of the dollar, besides just the 6 components in the U.S. dollar index, their G10 currency index here, it's got the New Zealand dollar, the Norwegian krona, the Aussie dollar added to this. It didn't print fresh lows, or it didn't revisit the lows from earlier in the year, nor did our US dollar AD line composed of 29 pairs. So that was
so what does that mean? What does all this mean?
That there was a lack of broad dollar weakness as the US dollar index revisited its lows from earlier this year. So that was a heads up, like, that 100 level, here, it's likely breaking in an environment where these charts are breaking lower as well.
But it's not happening.
But it's not happening. Exactly.
So we should expect the dollar, at least the DXY, to stay above 100 for now.
For now, absolutely.
Okay. All right.
Absolutely. And that's what we're seeing. Look at the US dollar index fund UUP. Instead of 101, we're looking at that 27.25 level. It's up around $28. Again.
All right. Oh, I'm sorry. Go ahead.
No, it didn't hit oversold.
Same story.
Yeah.
All right. Well, the theme of today's show is Forex. We haven't really outside of the recaps we do, we haven't talked too much about what's going on in the various Forex markets. But every week, we likes to compile a few of his favorite charts, and this week his favorite charts are all Forex related. So let's start with the first one, which is the euro dollar, and maybe you can explain to us not only just what the chart shows you, but just sort of the state of this market right now.
So the euro, like most markets right now, it's a range-bound mess. Zooming in, it broke above this key 108 level that I've had my eyes on for months now, but it's pulling back. So I really want to see that 108 level hold for the euro. And the reason I'm so interested in the euro and how it resolves at this level, because it comprises 57.6% of the US dollar index. So if the euro loses that 108 level and starts to catch lower back towards 103.50, and that's gonna create a tailwind. It's going to create a bid in the US dollar index. I've mentioned before, as long as the euro is above 108, that dollar index isn't going to catch above 105, right? On the other hand, on the flip side, if the euro loses 108, not only is the dollar index likely catching and staying above 101 and catching higher towards 105, it's breaking through. Dollar index is likely taking out that 105 level, but it's going to be in an environment where the euro is back below 108. Kind of along the same lines, and I mentioned the pound last week or the week before, how much I just really like the breakout here in the pound. And a really nice, slow kind of rolling bid here through this 124.25 level. Now it's pulling back and it's retesting. So British pound, another big component of the dollar index. If that 124.25 level does not hold, which it's 124.82 right now as we speak, euro 108.31. So they're hanging in there, but it's close. So back below this key level, again, the dollar index is gaining momentum and fuel for a much stronger rally than just a good week like you had last week. And then finishing it up, I mentioned I shared with readers a few weeks ago, if you like buying the dollar, South African Rand, the USD ZAR pair was the way to go, and it's hitting new all-time highs. I really like this, which is base on base on base. Now this 26 target up here, 26.50. I know it's aggressive. I like it over longer time frames. When we zoom in, as long as US dollar ZAR is above 1850, I like it long towards 1975 above their secondary objective around 2150.
Okay, so a lot to digest from these charts here. What do you think? Just the prevailing, does the prevailing sentiment here just need to be that the dollar is in this sort of range bound sideways trend? Like I guess, or is there something different that you want people to know? And also, what's so special really about, like, why did you highlight the euro dollar and the dollar rand?
Well, I highlighted the dollar rand because it's a trade that's right. So long dollar trades are working. The short or long other currencies against the dollar, like the pound, are pulling back to our breakout levels. Right? This could turn out to be a successful retest, or it could turn out to be a failed breakout. Same thing with the euro. If we get a failed breakout in the euro and it's back below 108, then that speaks to broadening dollar strength. That speaks to the two charts down here continuing to catch higher, and then the dollar index catching up. And if the dollar index is above 105 playing catch up to the G10 currency index and this US dollar AD line, then risk assets, even gold and silver, are going to continue to come under increased selling pressure. And that's what everyone needs to know. Whether you trade, you know, the currencies, the FX markets, or whether you even trade commodities, it doesn't matter. Stock market bulls, investors need to keep an eye on the euro. They need to keep an eye on these currencies, especially now, because dollar strength poses a stiff headwind for stocks.
All right, we got a couple minutes left here. I know you had some energy charts as well you wanted to share.
Yeah, so I wanted to continue on with that weakness that we're seeing in copper and crude oil. Something that I've been looking for as energy has sold off was this potential bearish to bullish reversal in our equal weight base metals index, with the idea that we're going to see a rotation from one pro-cyclical commodity group into another. And we started to see that earlier this year. However, copper breaking down, and our equal weight base metal index is breaking down as well. So we're not seeing the type of bullish behavior. We're not seeing a healthy rotation that supports a sustained uptrend for commodities at the moment. Now, this is more near term. And when we look at the performance chart for commodity subgroups, since the dollar peaked, those pro-cyclical areas, energy, base metals, have really come under pressure compared to the more defensive groups like livestock, softs, and it's certainly precious metals. See precious metals starting to roll over here more recently due to the selling pressure hitting silver and gold last week and this week. So we're seeing a lot of defensive stocks and areas of the stock market start to outperform and do well. And we're seeing the same thing in commodities. Also looking at energy, that XLE was the bright spot. And we look to XLE and say, hey, the crude keeps breaking down, but look at energy stocks. They remain buoyant. So what's the deal here? Who's got it right? I think they both got it right. But the question is, will crude oil catch higher to XLE, or will XLE begin to break down to crude oil? That was the big question. What's going to happen here in this tight consolidation with energy stocks? Higher or lower? Well, it's starting to look like the breaking down. Now, this is a line chart showing the breakdown. These are just closing prices. We use a candlestick chart here. XL, the level is around 75.50. XLE still holding above that level, but it has violated a multi-year uptrend line. And we're just not seeing positive rate of change here. We never saw that boost. We never saw buyers come in and continue to support this trend. Instead, we've seen a sideways consolidation that looks like it's going to break down. And in that scenario, energy continues to catch lower, base metals are catching lower. We're losing that one bright spot in the energy space, those energy stocks. CRB index and our equal weight commodity index are most likely going to follow the Bloomberg commodity index lower.
All right. Let's highlight one sleeper chart today. I think you're looking at the emerging currency ETF, right? CEW, the Wisdom Tree Emerging Currency Fund.
Yeah, you talk about
what jumped out to you here?
Yeah, so what jumped out to me is it looks a lot like the bond charts. You know, they're the treasuries. They're carving out these constructive potential bases under key polarity zones. Just no real resolution yet. I think it's interesting to see emerging market currencies doing well. I wouldn't imagine that would be the case if commodities continue to break down, if global risk assets are under increased pressure, if the dollar is going to continue to rip over 105, excuse me, the dollar index. I don't know that that's happening in an environment where CEW and emergency currencies are catching higher. And it's just challenging this decade-long downtrend line. I think a bearish to bullish reversal in CEW could do a lot for the bull case for global risk assets, and definitely hamper any kind of potential sustained rally in the US dollar. And this is also interesting. I thought, look at this massive base. Emerging market currencies versus the euro. And we get a big reversal here. Maybe emerging market currencies take off. If you remember, back here in 2010 to 2011, that was that final leg higher in commodities in the last cycle. Gold ripped up to 2011 highs around 1924. We get another explosive rally here.
Looks like some pretty clear resistance until otherwise broken on
absolutely.
that one. All right. Ian Culley is the head of fixed income commodities and currencies at All Star Charts. If you want access to Ian's charts, Ian's research, Ian's blog post. I just dropped the link in the chat. It's also in the description of this video on YouTube. It's allstarcharts.com/join. We need to get something on the screen that indicates where to go. Izzy, remind me to talk to you about that. So that's where you can find Ian's research. And we'll be back on Friday for our next show. And in the meantime, everyone, a happy trading. Drop us a like on YouTube if you can. That would be very helpful. And Ian, good luck out there. Everyone trading, good luck out there. Good luck trading Forex, currencies, commodities, fixed income. And we'll catch you on Friday.
Have a great week.